This week, we are going to focus on one of the financial statements called the Statement of Cash Flows. Now, we've talked about this statement a little bit in a couple chapters, but this chapter is devoted entirely to the Statement of Cash Flows. Know that the Statement of Cash Flows is a statement that shows where cash comes from and where cash goes. And there's 3 types of activities in how we categorize the Statement of Cash Flows. 1 is operating activities. This includes cash receipts and cash payments for transactions relating to revenue and expense activities. Guys, it's pretty much the reason the company's in business. Most of the activities will involve why the company's in business. There are 2 others. There's investing activities and financing activities. Investing activities are cash transactions involving the purchase and sale of long-term assets and current investments in another company. Financing activities are the inflows and outflows of cash resulting from external financing of a business, meaning issuing shares of stock, paying dividends on that stock, and borrowing money. Period. But most have to do with the operating cash flows. Guys, while I'm working, if someone wants to come and get another bagel, it doesn't offend me. Just come down and get another one, okay? So, the Statement of Cash Flows is broken down with activities involving operating, investing, and financing. Now, here is a financial statement, the Statement of Cash Flows. You see, we break down cash flows from operating activities. And that's going to be primarily most of the activity. Then you show cash flows from investing and cash flows from financing. The non-cash activities are not going to be a part of the Statement of Cash Flows because the Statement of Cash Flows is about cash. Okay? Note that operating activities, what will come in, inflows involve the sale of goods and services, and when a company collects interest and dividends. Okay? When a company receives interest and dividends. Cash outflows relate to inventory, operating expenses, interest, and income taxes. When we're dealing with investing activities, inflows involve the sale of investments, the sale of long-term assets, or if we collect notes receivable from a client. Okay? Not accounts receivable, but a note receivable. We lent somebody money or another company money, and we're receiving that investment, that note. Cash outflows would be the purchase of investments, the purchase of long-term assets, and when we lend money to either a customer or another company with a note receivable. Cash flows from financing activities. Inflows would be when we issue bonds or notes payable, or we issue stock. And then the outflows would be repayment of bonds or notes payable, acquisition of treasury stock, and the payment of dividends. Now, guys, of dividends for people who own stock in the company and we pay dividends, okay? Don't confuse when the company receives dividends to what we're talking about when we pay stockholders dividends. Does that make sense? Paying stockholders dividends would be financing activities. Guys, this is a really important slide to, kind of have on your side when we're doing work to keep up with what we're looking at here. Students, here it is. Students sometimes misclassify dividends in preparing the statement of cash flows. Dividends received are included in operating activities. Dividends paid are included in financing activities. Okay? So, in order to prepare this statement of cash flows, we want some information from the income statement, from the balance sheet, and some detailed records, accounting records. But a lot of what we're going to see is the income statement and the balance sheet. Know that we're going to take information regarding the income statement, the revenues and expenses, and off of the balance sheet, we are going to take, for the assets, changes in other current assets and changes in current liabilities. And I'll tell you about it in a minute. But we're going to take those items to help us complete the statement, the section of operating activities. We're going to take the changes in long-term assets to complete the investing activities. And then we're going to take changes in long-term liabilities and the stockholders' equity section to complete the financing activity section and come up with our statement. So remember, if it doesn't involve cash, is it going to be in the statement of cash flows? No. We only will show non-cash activities in a note to the financial statement. Okay? Examples of what it means to have a non-cash activity. You purchase an asset and you just issue debt for the whole thing. Do you see cash wasn't exchanged? So you purchased this truck by taking out a note. We didn't use any cash, therefore it's not going to be in here. Or what if we purchased this truck by issuing stock? Cash was not involved. Or what if we had a note, a debt, bonds payable, and instead of paying it back, we just issued stock? Cash wasn't involved. So these items, guys, won't be in the statement of cash flows because it doesn't involve cash. Okay, so just be aware of that. Or let's say you literally exchange one asset for another and cash was not involved. Then it won't be in here. Now, guys, we have in the past, when we've looked at the statement of cash flows, and we've done a couple activities on exercises, we've always used what's called the direct method. The indirect method versus the direct method. Both methods report investing, financing, and non-cash activities identical. But The operating section is different. We're going to spend this chapter looking at a new way of completing the statement of cash flows, what we call using the indirect method. We start with net income, and then we adjust. We use these different categories to adjust the statement of the activity section, operating section. We list adjustments to net income to arrive at operating cash flows. Honestly, the direct method can make more sense to us, the way we've done it in the past, but this indirect method is cheaper, easier, and what's most commonly used. So that's why you're going to learn it. Okay? So the direct method is not that common, and if a company uses the direct method, they also have to show the indirect method. Companies choose between the indirect method and the direct method in the statement of cash flows. The indirect method is less costly to prepare and is used in practice by most companies. The direct method more logically presents the cash inflows and outflows from operations. The investing and the financing sections on either method are identical. Okay? Identical. So, we're going to start with exercise here 11.3. Analysis of an income statement, balance sheet, and additional information from the accounting records of Gadget reveal the following information. Indicate in which section of the statement of cash flows each of these items would be reported. Would they be reported in the operating section, in the investing activities, financing activities, or in a separate, in the non-cash notes? So just take a minute and look and just get an idea. What do you think is going to happen here? I'll give you 2 seconds here. Please eat another one. My favorite are the onion. And the garden veggie I love. Okay, guys, let's look. Whoops, sorry, I guess it all just popped up. Think about it. When we purchase a patent, what is a patent? An asset, isn't it? A long-term asset? So wouldn't that be in the investing section because it's a long-term asset? Make sense? Depreciation expense is an operating activity section. Decreasing or increasing accounts receivable or accounts payable. Current assets or current liabilities always goes in the operating section. Issuance of a note payable. Isn't that financing? Long-term debt. Increase in inventory is operating because you cannot eat a bagel and talk. Sorry. Increase or decrease in inventory is in the operating section because that's a current asset. collection of a note receivable, investing. Purchase of equipment, long-term asset, investing. Exchange of a long-term asset, no cash is involved, right? Decrease in accounts payable, current liability, operating. Payment of dividends. Remember, if the company receives dividends, it's operating. But if we're paying out dividends to the shareholders, it's financing. Okay, does that make sense? Which of the following would be included in the operating activities section of a statement of cash flows? In the operating section, what do you guys think? Okay, why wouldn't it be A?
This is a long-term asset.
And long-term assets go where?
Investing.
Why wouldn't it be B? Why wouldn't it be D?
Not cash.
Issuance of common stock is financing. It's a way we bring in money. We borrow. C, increase in the balance of accounts payable. Current assets. Changes in current assets and changes in current liabilities will be part of the operating section. So, in preparing the statement of cash flows, we're going to first start by looking at net cash flows from operating activities. Then we're going to look at investing activities. Then we're going to look at financing activities. We're going to combine them. And from what we started the year with, plus the changes in cash flows for the year, should equal the cash on the balance sheet, the ending cash balance on the balance sheet. So here we have eGames. We have the sales of $1,012,000, and we have all the expenses with net income of $42,000. Then we have the difference, or a comparative balance sheet showing the balances in cash and or in assets and liabilities in 18 and 17 and the changes. No, when we show an increase or a decrease, we're comparing the most current year to the previous year. So when we say cash increased by $14,000, that's because in 2018 cash was at $28,000. 2017 it was $48,000. It increased from 17 to 18 by $14,000. Does that make sense? Do you see here accounts receivable increased from $20,000 in 17 to $27,000 in 18. So we show that current asset increased $7,000. In this case, inventory decreased. It went from $45,000 down to $35,000. It decreased from one year to the next. Prepaid rent is a current asset. Prepaid rent increased from one year to the next. Then we show our long-term investments. We can tell here, guys, in 17 our investments were $0. In 18 our investments were $35,000. Didn't we need cash to probably get that investment? We don't know yet for sure. We'll need more information. But if in fact we paid that with cash, that would have been a use of cash and investing, isn't it? Land, look at that, guys. Land went down from 80. It decreased 70,000. Equipment increased by 20,000. And you see here our accumulated depreciation really shows what we had in depreciation expense for the year. That increased 9,000. Here in our liability and stockholders equity section, you see our accounts payable went from 27,000 in 2017 to 22,000 in 2018. It decreased. Think about, why would an accounts payable decrease? Wouldn't we have used cash to pay it down? So wouldn't that be a use of cash? Make sense? Interest payable went from 1,000 to 2,000. It increased. Income tax payable went from 7 to 5. It went down because we probably paid the income tax that was due the government. Note payable went from 75 to 95. That's an increase of 20,000. When debt increases, isn't that a financing activity? Do you guys get what I'm trying to do here? I'm trying to make it make sense to you. Then we have our common stock increased, and our retained earnings increased because we had net income and we probably paid some dividends out. Okay? So what I'm just trying to do is kind of go through this balance sheet and kind of explain so it makes a little more sense to you. Then we have some additional information. We purchased stock in Nintendo Corporation for $35,000. What is that, guys? When the company invests in another company. Investing. We sold land originally costing $10,000 for only $6,000, resulting in a $4,000 loss on the sale of land. But guys, when we sold the land, that's investing, isn't it? When we purchased $20,000 in equipment by issuing $20,000 note payable due in 3 years, no cash was exchanged. What do we do there? Nothing. Because it's telling us it was a non-cash event. Okay? So hard to try to teach when I want to eat. When we issued common stock for $5,000 cash, what happened there, guys? We received cash. That was a cash inflow. When we declared and paid a cash dividend of $12,000, what is that? Financing also. So, that's the information we have to prepare the statement of cash flows. The first thing we do is we go to our income statement and come up with the net income. You see here the net income is $42,000. First thing we do is show our $42,000 net income. Then what we're going to do is we are going to make adjustments to net income from changes in current assets and current liabilities, right? Then we'll do our investing, and then we'll do our financing. We'll know when we do this, there is a net increase in our cash throughout the year of $14,000. If we began cash at the beginning of the period of $48,000, that means at the end of the period it's $62,000. I want you to see this 48 is what we show here. And do you see our cash at the end of 18 shows 62? And do you see how it ties in to this? Okay? Make sense? The first step is to calculate the net cash flows from operating activities using information from the income statement and changes in current assets other than cash and current liabilities. To provide a reconciliation from net income, the accrual basis, to net cash flows from operating activities, we need to remove non-cash activities from net income, so that what is left is operating cash flows only. So, items in our income statement that helped reduce our net income but didn't involve cash, we need to add those back. Because remember, we're an accrual basis. We learned all about appropriately showing income and expenses to match. And sometimes we don't necessarily have a cash transaction at the time. They need to, in different reasons, owe it in the future. Or in the case of depreciation, we purchase this piece of equipment, but we take and allocate a portion of this asset over the years of its useful life. So we, in fact, have an expense called depreciation expense that lowers our net income, but we really didn't use cash to show that, so we need to add that back. So in calculating our operating cash flows, we're going to add back depreciation. Then we're going to look at these non-operating items, gains and losses on sales of assets. Then we're going to show the changes in current assets and current liabilities. If there's an increase in accounts receivable, is the amount of revenue reported in the income statement, but cash was not yet collected. So guys, I want you to think about this. When there's an increase in an accounts receivable, generally what that means is we provided a service or sold something, but we haven't gotten the cash yet. But doesn't that increase our sales? But since we didn't necessarily get the cash yet, we need to do some adjustments for our operating cash flows. Hardware Suppliers reports net income of $165,000. Included in net income is a gain on the sale of land of $20,000. A comparison of this year's and last year's balance sheets reveals an increase in accounts receivable of $35,000, an increase in inventory of $20,000, and a decrease in accounts payable of $55,000. Prepare the operating activities section of the statement of cash flows using the indirect method. So we'll start with our net income of $165,000, and then we need to adjust. There initially was a gain on the sale of the land, but since this is the operating section, we're going to get rid of it because the gain on the sale of land we don't want to show here. If there's an increase in accounts receivable, if you think about it, that increase said we sold something or we provided a service but haven't gotten cash yet. So we're going to subtract it. If there's an increase in inventory, we are going to subtract it. because we somehow got more inventory and we used cash to get that inventory. And then if you think about it, at a decrease in accounts payable, we used cash too. Because to reduce our accounts payable, the only way you reduce it is why? Pay it off. So if we start with net income at $165,000, let me just fix this a minute. If we start with net income of $165,000, and then we have to subtract the gain on the sale of land, the increase in accounts receivable, increase in inventory, decrease in accounts payable, we only show net cash flows from operating activities here of $35,000. Now, they're asking, does this look fishy? It kind of does look fishy if you think about it, because all of these adjustments are subtracting net income. It could really be true, or it could be management's faking the numbers, or trying to puff up their income by showing their income increase, but yet they haven't received the cash yet. See what I'm saying? It could be true. Which of the following would be included as an adjustment to net income in the operating activities section of a statement of cash flows using the indirect method? A. So, to complete the operating section, we start with net income. We will adjust items that reconcile net income to net cash flows by taking any depreciation expense or amortization expense and adding them, by adding a loss on sale of assets, or subtracting a gain on the sale of assets, and then we subtract increases in current assets and we add decreases in a current asset. But in terms of current liabilities, we will add an increase in a current liability and we will subtract a decrease in a current liability to get us to the net cash flows. Now guys, this is a really important slide because sometimes it can be confusing as to why we're adding and why we're subtracting. And so to have this on hand, to know if there is an increase in a current asset, we do the opposite. An increase, we subtract. A decrease in a current asset, we add. You do the opposite for current assets. For current liabilities, you follow it. An increase in a current liability, we add. A decrease in a current liability, we subtract. Think about it. If a current liability decreases, it's because you used cash to pay it off, which means it would have reduced your cash. With an increase in a current liability, think about it. You probably had an expense on the income statement, which caused the accounts payable. So you had an expense without really paying the bill. Okay, that's why you add it. eGames reports net income of $42,000 and depreciation expense of $9,000 in its income statement. We start with the $42,000, and what are we going to do with their depreciation expense? We're going to add it, $9,000. eGames sold land originally costing $10,000 for only $6,000, resulting in a $4,000 loss on the sale of land. We're going to add that back because we don't want to show gains or losses in the operating section. Okay, so we're going to add it back. Students sometimes are unsure whether to add or subtract a loss on the sale of assets. But remember that a loss is like an expense. They both reduce net income. Treat a loss on the sale of assets like depreciation expense and add it back to net income. A gain on the sale of long-term assets is the opposite of an expense, so we subtract it from net income to arrive at net cash flows from operating activities. We want to get rid of net gains or net losses because they don't fit in the operating section. So a gain adds to net income, therefore that's why we're going to subtract it. A loss reduces our net income, that's why we're going to add it back to get rid of it. Does that make sense, guys? Now, when we're dealing with current assets and current liabilities, you will subtract an increase in a current asset and you will add a decrease in a current asset. Remember, do the opposite that it's what's happening. If a current asset is increasing, you're going to subtract it. If a current asset is decreasing, you're going to add it. You're going to do the opposite. But you're going to follow, with current liabilities, you're going to follow the same pattern. If it's an increase in a current liability, you're going to add it. If it's a decrease in a current liability, you're going to subtract it. E-Games, accounts receivable increased $7,000 during the year. It went from $20,000 to $27,000. If it increases, what are we going to do? Subtract it. An increase in a current asset, we do the opposite. We subtract it. Got it? E-Games inventory balance decreased by $10,000 during the year. If there's a decrease in a current asset, we're going to do the opposite with it. We're going to add it. E-Games prepaid rent increased $2,000 during the year. Hey guys, why would a prepaid asset increase? We paid cash into it. That's why we're decreasing it, aren't we? Because we used cash to make it increase. Make sense? We're subtracting it. E-Games accounts payable decreased $5,000 during the year. What's going to happen when a current liability decreases? We decrease it because we used cash to get it lower. We're going to subtract it. E-Games interest payable increased $1,000 during the year. We're going to add it. Okay? E-Games income tax payable decreased $2,000 during the year. What happens when a current liability decreases? We decrease it too, don't we? We subtract. So we show all these adjustments and we take our $42,000 plus our $9,000 plus our $4,000 minus our $7,000 plus our $10,000 minus our $2,000 minus our $5,000 plus our $1,000 minus our $2,000, and we get $50,000. Okay? Using the indirect method, we start with net income and we adjust this number for revenue and expense items that don't affect cash, gains and losses that don't affect operating cash flows, and changes in current assets and current liabilities. Does that make sense, guys? Portions of the financial statements for Peach Computer are below. We see our sales. We see our cost of goods sold, operating expenses, depreciation expense, income tax, and our net income. Then we see our balance sheet, the changes. Okay? What's the first thing we're going to do when we create a statement of cash flows on the operating section? What's the first number we do? Net income. See, it's 130? Well, that's what we do. We start with net income. Then we need to add back depreciation expense. See how it was 60 here? We add it back. Then, what are our current assets here? Accounts receivable, inventory, and prepaid rent, aren't they? What happened to accounts receivable? A decrease. So what are we going to do? We do the opposite. We're going to add. We add the decrease in accounts receivable, we add back. What happened to our inventory? If it increased, what do? We decrease it. We're going to subtract $25,000. Then, our prepaid rent decreased. It went from 7 to 4. What do we do when an asset, a current asset decreases? We add it back. That makes sense, guys? Then, with current liabilities, we follow the same pattern. An increase in accounts payable from 42 to 55. If it increased 13, what do we do with it? We add it. See how we added it? If it decreased, what do? We subtract it. Make sense? Kind of? Guys, which of the following items would be added back to net income in the operating activity section of a statement of cash flows using the indirect method? Y'all said C? What do you think? Now, the investing and the financing sections are pretty straightforward. They're pretty easy. Increase or decrease in investments. Increase or decrease in long-term assets such as property, plant, and equipment, along with intangibles like a patent. So when eGames purchased investments for $35,000 cash, they sold land originally costing $10,000 for only $6,000. They purchased $20,000 in equipment by issuing a $20,000 note payable. We know purchasing equipment for $20,000, issuing a $20,000 note payable, there was no cash, so we're not going to do anything there. But since we purchased investments of $35,000 for cash, we used up $35,000 of cash. So do you see purchases of investments minus $35,000? And then we sold land for $6,000. That's an increase of cash for $6,000. All we care about is the cash we got in. We don't care about gains and losses here. We're just talking cash. We received $6,000 in cash. That's what we show came in. That, our net cash flows from investing is now a minus $25,000. The minus $35,000 plus the $6,000, right? Got it? Now, we can put a note just a note. We don't add it to our statement of cash flows. We can say a non-cash activity, we purchased equipment by issuing a note payable. It's just a note in the financial statements. It's not part of the statement of cash flows. Examine financing activities. We'll look at long-term liabilities in the stockholders' equity section from the balance sheet. And we'll look at those cash transactions with the company's creditors and shareholders. So if eGames issues common stock for $5,000 cash and paid dividends of $12,000, by issuing $5,000 in common stock, the company receives $5,000. And paying dividends of $12,000, we reduced our cash by $12,000. So our net cash flows from financing is minus $7,000. Does that make sense, guys? Yeah? Most investing activities can be explained by changes in long-term asset accounts. Most financing activities can be explained by changes in long-term liabilities and stockholders' equity accounts. What about this one, guys? Which of the following would be included in the investing activities section of a statement of cash flows? A? Which of the following would be included in the financing activities section of a statement of cash flows? Excellent. So, our good eGames. We've gone through this entire statement of cash flows. We started with our net income. We created all these adjustments. Then we did the investing section, the financing section. We showed our increase in cash for the year. We took our beginning cash balance. We added the increase in cash, and do you see how we ended with $62,000? So, and then the financial analysis. Next week, we're going to cover all of them. And if you show up, I think doing this, but if you show up next week for the statement of on Zoom, what's going to happen? You get credit for only the quiz, the review, the homework, and the quiz. So it's worth it. But if you don't show up by 8:05, what's going to happen? You know what's going to happen? You're going to get mad at me because I just didn't I didn't let you get the benefit. But you know now to do it, right? Okay. Now, we have in the past, when we've talked about the statement of cash flows, we have used what's called the direct method. To me, it makes more sense, but it's a little more complicated to do. When we use the direct method, we report the cash inflows and cash outflows directly instead of trying to adjust these accounts. And we convert revenue and expense items to its cash basis amount. Income statement items that have no cash effect are not reported. So when we use the direct method, we will show cash received from customers, cash received from interest, cash received from dividends. Or outflows, cash we paid to suppliers, cash paid for operating expenses, cash paid for interest, cash paid for income taxes. Do you see how it's just straightforward? But the problem is we have an accrual basis income statement, don't we? So we don't show things just in cash. That's the whole reason we're taking this class, is to understand the generally accepted accounting principles, how we match our expenses with those revenues they help to earn. So when we prepare the operating activity section of the statement of cash flows, we had our net sales. Think about this. Our sales were at $2,050,000. We had a decrease in our accounts receivable. Now, guys, when we have a decrease in accounts receivable, we know to add it, don't we? We do the opposite. So the way we can find out the real cash we receive from customers is by taking our sales and then a decrease. Think about this, guys. A decrease in accounts receivable. Basically what that means is we recorded that revenue in the year we earned it, or in that period we earned it, not necessarily when we got the cash. So a decrease in an accounts receivable means we got cash, doesn't it? Do you see why we add it? Make sense? Because we received the cash. We got to change our thinking and think cash, cash, cash. What's happening to cash? So the way under the direct method we can figure this out is we take our sales, and if there's a decrease in accounts receivable, we're going to add it to say cash received from customers. Now, guys, this cost of goods sold can be the trickiest because you're going to have a homework problem like this. So see this. Think of cost of goods sold. Know, in order to figure out how much we paid in inventory, the cash we paid to suppliers, we're going to take our cost of goods sold, we're going to add back any increase in inventory, and that equals how much are in purchases. And then we're going to subtract our increase in our accounts payable, and that allows us to know how much we actually paid out to suppliers. It's most helpful if you have this formula written down, okay? Because for me, it's not real intuitive. So to calculate the cash paid to suppliers, you're going to take your cost of goods sold, you're going to add your increase in inventory, which means you will also subtract your decrease in inventory, and that gives you your purchases. Then you're going to subtract increase in accounts payable, or you're going to add a decrease in accounts payable to get your cash paid to suppliers. Just know that. Now, operating expenses, the way we can figure out what we really paid, if there's a decrease in prepaid rent, we would subtract it. Okay? There's an increase in prepaid rent, we're going to add it. Cash paid for income taxes, if there's a decrease in income taxes payable, we're going to add it, because to decrease that payable means we paid it. We paid cash for income taxes. Okay? Here is, using the direct method, the operating section. Cash received from customers, $2,058,000. This is how we calculated it. Cash paid to suppliers, $1,162,000. Here's how we calculated it. Cash paid for operating expenses, cash paid for income taxes, our net cash flows from operating. The direct method is done totally different. Guys, it makes sense, but it's harder to do. Okay? Which of the following sections of a statement of cash flows will be different depending on which method, direct or indirect, is chosen to prepare it? What are we doing? Just operating, right? It's just the operating section is different. The other two are exactly alike. Okay? Okay. I'd like to go over some questions. We can get some questions from the back of the book, or we can look at some homework. I want you guys to tell me what you want to do. Everyone tell me. I figured someone back there would say, well, we shouldn't have to do homework this week. I'm giving you a hard time. Guys, I've pushed you really hard. I know it's a tough class, but do you kind of see why I have to? And it's, I like to be able to lighten up. And we're at the end, and we can lighten it up a little. But if I would be light at the beginning, guess what happens? Everyone takes advantage of it. Do you blame them? It's like a kid. No, I'm not trying to say it. I didn't mean it disrespectfully like that. Okay. I'm going to show you what happens to kids when they get everything they want. And I promise this is the last time I'm ever going to show you a picture of my kids. Well, I guess I can't. Oh, here it is. So sometimes I love to spoil my son, and he has my credit card, and so sometimes, or at least weekly, he orders food. And now this little kid's my favorite, but he's being a little,
Solomon,
what?
can you say thank you to Nana for this delicious food? No. Hey, Dami, would you say thank you to Nana for this delicious food? Ambrose, would you say thank you to Nana for this delicious food?
Thank you, Nana, for this delicious food.
Thank you, Nana, for this delicious food.
Thank you, Nana, for this delicious food. And Hagel will say thank you when he comes inside.
But no, look at this little one. He's my favorite, but
Did you
he's
say
a
thank you to Nana for this delicious food?
little...
Hey,
No!
Dami, did you say thank
Little stinker. See, I didn't want you being like that at the beginning of the semester, so I had to make you tough. Okay, what are we doing? We're doing schoolwork, right? Oh my gosh, what am I doing wrong? Oh, here. Okay. So, listed below are, and I promise you'll have plenty of time to look again, guys. But good idea to take a picture of it first. But what I want you to do is I want you to think, okay? I didn't mean think like I want you, but think it through. Listed below are several transactions. For each transaction, indicate whether the cash effect for each transaction is reported in a statement of cash flows as an operating, investing, financing, or non-cash. And if it's an inflow or an outflow. Okay, just logically think, when we pay employee salaries, it sure as heck doesn't come in, does it? It goes out. Make sense? It's an outflow. And isn't that why the company's in business? To, receive goods or services, or, receive payment from goods and services. And in order to do that, all the necessary expenses are operating. Make sense? So, payment of employee salaries, does it make sense it's operating? The sale of land for cash. When we purchase or sell a long-term investment, what is it? Investing. When we purchase it, we use cash. But when we sell it, we receive cash, don't we? Purchase of rent in advance. Think about it. Operating section involves current assets and current liabilities, right? Rent is just a necessary piece of the equation. Purchase of rent in advance, outflow. Collection of an accounts receivable, again, it's a current what? Asset. It's an inflow, and it's operating. Issuance of common stock, financing, inflow. Purchase of inventory, current asset. Collection of notes receivable. Remember, investing is the purchase and sale of long-term assets, current investments, or notes. Payment of income taxes, why the company's in business. Operating. Sale of equipment for a note receivable, non-cash. Issuance of bonds. Do you understand why it's financing? Financing is issuance of stock, paying dividends, or borrowing money or paying back money. Loan to another company. Investing. Payment of a long-term note payable. Financing. Purchase of treasury stock. Remember? That was that whole financing section we talked about last week. Stockholders' equity section. Payment of an accounts payable. What is an accounts payable? Isn't that a current liability? Sale of equipment for cash. Investing. Right? Is it kind of making sense, guys? Okay. Seth Erkenbeck, a recent college grad, has just completed the basic format to be used in preparing the statement of cash flows for ATM software. All amounts are in thousands. Listed below in random order are line items to be included in the statement of cash flows. Prepare the statement of cash flows for ATM software using the indirect math method. Amounts to be deducted, cash outflows, and any decrease of cash should be indicated with a minus sign. So guys, I'm going to show you the answer, but let's kind of go through this. So, cash received from the sale of land. Where is that going to go? Investing. Issuance of common stock. Financing, that's an inflow. Both of those are inflows. Depreciation expense. Operating, you'll add it back. Increase in accounts receivable. Operating as a decrease. You'll subtract it, won't you? A decrease in accounts payable. Operating will be a subtraction. Issuance of a long-term note payable. Financing, and it's a cash inflow, right? Purchase of equipment. Investing is an outflow. Decrease in inventory. Think about it. A decrease in inventory. Inventory is a current asset. When a current asset decreases, what do? You add it. Operating. Decrease in prepaid rent. You add it. Payment of dividends. Financing. Where's the net income go? At the very top. Purchase of treasury stock. Financing. And is it an inflow or an outflow? It's an outflow. You use money. So this shows you start with your net income. Here are the items in the operating section, the inflows. Here are the outflows. Excuse me, I'm so sorry. This is the adjustments to reconcile cash flows from operating. Then you do, here's your operating section. Okay? Then here is your inflows and outflows from investing. Here are your inflow and outflows from financing. You then take these and add them together to show an increase or decrease in cash. You start with the beginning cash for the period, and this ending cash should equal your balance sheet cash. Any questions on this? Does it make sense? Portions of the income statement and the balance sheet are shown here. Prepare the operating activities section of the statement of cash flows. What are we going to start with, guys? Net income. We're going to start with net income of $56,000, right? Then, what will we make an adjustment with? Which one of those expenses will we adjust right away? Depreciation we add back. Then, when we have a decrease in a current asset, what do we do with it? Increase it. We go with current assets, we do the opposite. with current liabilities, we follow it. So a decrease in accounts receivable will add back. An increase in inventory, we will do what? Subtract. A decrease in prepaid rent, we will add. Now we have some payables, current liabilities. Increase in salaries payable, we add. Decrease in accounts payable, subtract. Increase in income tax payable, we add. Let's go to the next one. I'll go back to this though. Okay. Now, we've got the income statement and we've got the balance sheet. And then we have some information here. So, again, guys, it's the same concept though. It tells us purchased investment in bonds for $115,000. So this is an investment. A current investment is what? An investing activity, right? Right? Sold land for $31,000. The land originally was purchased for $40,000, resulting in a $9,000 loss being recorded at the time of the sale. So, to adjust our operating activity section, we'll have to add back that loss. But when we sold land for $31,000, that's a cash inflow in what section? Investing. Purchased $70,000 in equipment by issuing a $70,000 long-term note payable to the seller. What do we do here? What? Non-cash, we do nothing, do we? When we declared and paid a cash dividend of $30,000, that is a cash outflow in what section? In financing. So to do this statement of cash flows under just the operating section, indirect, what do we start with? Net income. Then we're going to do some adjustments. We'll adjust depreciation. We'll add back $37,000. What are we going to do to the loss on the sale of the land? Add back. Okay. Then the cash we ignore. Our accounts receivable increased. What do we do in an accounts receivable? A current asset increases. Subtract. Our inventory decreased. What do we do? Add. Our prepaid rent increased. What do we do? The investment we're aware of. The land we know we handled. There is a decrease in accounts payable. What do we do? Subtract. There is a decrease in interest payable. There is an increase in income taxes payable. Add. Does that make sense, guys? Here are ratios. Now, this is using the direct method. This direct method, here's the key, and you're going to have this in your quiz. Remember, here is the accrual basis. But using the direct method, you have to adjust when you have sales and you have a decrease in accounts receivable. Won't you take your sales and add the decrease in accounts payable to get to what the clients actually you receive from clients? Remember? This is key, guys. To me, the hardest one is cash paid to suppliers. Okay? So just make sure you understand the formula. The cost of goods sold plus increase in inventory you add, or a decrease in inventory you subtract, gets you to purchases. And then you add the decrease in accounts payable, or you will subtract the increase in accounts payable, get you to cash paid for suppliers. To me, that's the toughest. Okay? And then last, I'm going to let y'all do that one on your own. So